Most investors are out here struggling for $200, maybe $300 in monthly cash flow, when one simple loan feature could boost that cash flow by hundreds without raising the rent. And almost nobody is talking about it. It's not a trick, it's not a loophole, it's not a hack. It's called a DSCR interest-only, and it might be the strongest cash flow tool in the investor's world right now. Here's the crazy part. Investors are out here fighting for deals, stressing over numbers, passing on properties that would have cash flowed beautifully, simply because no one explained this loan to them correctly. So today, I'm breaking it all down. What is it, how it works, why it boosts cash flow so dramatically, and when you should and should not use it. By the end of this video, you're going to understand something most investors don't, and that alone puts you ahead. Cash flow is the #1 reason investors walk away from deals. But what if the deal was good and the loan was the problem? Interest-only DSCR can make a negative cash flow deal turn positive, increase monthly profits, reduce monthly payments, help you scale faster, lower your break-even point, reduce vacancy risk, increase ROI, make Airbnb star numbers explode. This strategy has helped countless investors go from barely breaking even to creating real passive income each month. This video will give you the knowledge to do the same. If you're new here, welcome to the Mortgage Cafe with Angelica, where we sip on coffee and talk all things real estate, investing, and building true wealth. I'm Angelica Obregon with Key Mortgages, your bilingual investor loan advisor for Georgia, Florida, and beyond. Before we jump in, if you love learning how to invest smarter, how to scale, and how to use money as a tool, like this video, subscribe, and share it with someone. It helps me help more families, investors, and realtors build wealth. Now, let's talk about this interest-only magic. A traditional mortgage is simple. Every month, your payment covers interest and principal. With interest-only IO, the first 10 years, sometimes 5, sometimes even 7, you only pay the interest portion, meaning lower payments, higher cash flow, more profit per month, more breathing room, more stability. Think of it like turning your property into a cash flow machine, especially for short-term rentals or high-demand areas. After the interest-only period, the loan converts into a normal amortizing loan, or you refinance before then. Let me break down an example. $400,000 rental property, so the traditional DSCR payment around $3,000. Interest-only DSCR payment $2,100. That's a difference of $900 a month. That's the difference between passing on a deal and cash flowing like crazy. Imagine that across 3 properties. That's potentially $2,700 in additional monthly profit. That is why mid-level and advanced investors love interest-only. It lets the property scale you instead of the other way around. Now, this strategy is perfect for short-term rentals investors, Airbnb, because cash flow is king and income varies. Investors scaling fast, who need lower carrying costs, people doing BRRRR, lower payments equal more stability while renting it out. Self-employed investors who want flexible cash flow, portfolio builders, more cash flow equals more down payment for the next deal. Those holding 5 to 10 rentals already, where small payment wins add up big. Anyone who values monthly profit over equity pay down. Interest only is a strategy, not a shortcut. Keep that in mind. Now let's keep it real. Interest only DSCR is not for everyone, so you need to avoid it. If you plan to sell within 2 to 3 years, you want the fastest principal pay down, you're very risk adverse, you don't understand the cash flow strategy, you want a home you'll live in, not for primary home. And remember, your payment will increase after that interest-only period if you don't refinance first. So that's not a trick, that's a tool. A smart investor knows how to use it. If you're learning something new today, go ahead and like this video, subscribe, and share it so I can help more investors, families, and realtors understand these powerful strategies. Make sure you comment below cash flow if you want more videos like this. Now let's talk strategy. The fun part. Maximize cash flow equals save for next down payment. Lower monthly payments equals leftover cash and faster scaling. Now, Airbnb income fluctuates. A lower base cost equals safer operations. Now, combining the both is very powerful. You buy with hard money, you rehab, stabilize the income, refinance into an only DSCR, free up the cash flow, repeat on the next deal. That's it. And then lower vacancy risk. Lower payments equals lower break-even points. If you've ever stressed about vacancy, Vacancy, interest-only makes the risk way smaller. Now, even with an interest-only DSCR, lenders still evaluate rent or Airbnb projected income, credit score, usually 660 and above, property type, cash reserves, down payment, anywhere between 20 to 25%, LLC or personal purchase, market demand and comps, DSCR ratio 1.00 and above. It's typically the normal. And yes, rental projections and market comps do matter. So here's the truth. Interest-only DSCR isn't about paying less. It's about making more. It's about optimizing cash flow, reducing risk, scaling faster, buying more rentals, building a real portfolio. If you want to know whether interest-only DSCR is right for your next property, make sure to visit mykeymortgages.com or click the link below for a free investor strategy call. That's your sip of wisdom from the Mortgage Cafe with Angelica, where we turn home ownership into wealth one key at a time. See you next video.